Bob, it's good to have you back here with us on a Friday. Welcome. We missed you last week. Let's dive into the retail sales number. I wanted just to begin with your initial thoughts. Better than expected across the board.
Yeah, good morning, Ben. I missed you last week as well. It's surprising to me to see this, to be honest, to see such a good beat on retail sales, not just because we were still, I guess you could look at it as the point in time, since this is the September figure where we were kind of reopening. There was advanced reopenings in the economy, but also you should have had the pullback from that excess unemployment payment that was coming. That extra $600 a week had been gone for into a month at this point. So you would have expected to see a little bit of slowdown. I'd like to dig into the numbers. I obviously can't right now, and see how much of this is about back to school and sort of a retooling or that homeschooling that went on. But it still can't be that big of a number. It's got to be a general consumer rebound to have this big of a beat. I could see that sort of back to school beat maybe accounting for 0.5% of it in the core figure. But still, this is a very big beat, and I think equities are responding in the correct way seeing this.
Yeah, and then what I think really stands out is amidst this beat here in terms of retail sales, the interesting aspect associated with this is, okay, so maybe we're out there spending, but we were talking about at the top of the show, numbers out of Europe not necessarily reflecting any consumer inflation. Also, the data that we saw here in the U.S., CPI, PPI, again, fairly muted for the most part. So while we're spending, I guess we're getting a lot for our buck as we are.
Look, over the last 10 years, actually more than that, going all the way back to 2009, you're talking about economies that have been growing without inflation. Yeah. It's something that years ago I called the Groupon economy. It's a little bit dated now, where essentially there's a bunch of commodities out there, and I don't mean commodities that we trade at the CME Group, I mean commodities in general. So for example, a running shoe is a running shoe is a running shoe if it's from the same company, and you have people competing just on price on these things and just on deliverability and service. And there's been very little consumer pricing power in the economy going all the way back to 2008, 2009, and that particular crash. You see essentially competition on price. And that's about the online revolution and the retail revolution that's going on. And I think that continues here. That is where the bulk of, other than Fed intervention, the bulk of the rally in the interest rates, in the equity markets came from, is that there was no inflation and there was consumer growth. Consumer is a driver of the U.S. economy. So if we're going to see that again, you're going to want to start looking for things to buy in the equities.
Yeah, a good point there. And I think that, again, as you mentioned, that retail as a revolution continues, and many would argue in some ways that the pandemic's only accelerated it. Let's talk about, in addition to retail sales, the inflation data, what's been on the minds of investors mostly this week. We mentioned stimulus measures, the focus on UK Brexit negotiations, but also how there's just been a little bit of a burn and churn and kind of wash, rinse, repeat type aspect to the headlines this week, whether you're talking stimulus, inflation data, Fed speakers. Really, what stood out to you, Bob, in terms of market moving news or something that's potentially setting up for something to keep an eye on in the coming weeks as we head into the end of the year?
Well, I think the lack of progress in stimulus talks and the lack of a sell-off on equities based on that, I think that's been kind of revealing. And that means one of two things. It means that the vast majority of market participants believe that equities can rise without a stimulus, or that they're just so confident, and I fall into this camp, they're just so confident that regardless of who wins the presidency and who wins the Senate, you're talking about a large stimulus package or a larger stimulus package. You're talking about a stimulus package or a quicker stimulus package, depending on what happens after the election. And by that, I mean, if it's a blue wave through the Senate and the presidency, it probably comes faster, it's probably larger. But either way, it's a buy the dip scenario, and the market's kind of proving that out. Now, that's a short-term fix. The economy does send a bill eventually. This doesn't go unpaid, and the economy will send a bill to the stock market. And that means a repricing of the stock market at some point. But from where we sit now, you have to be long equities and you have to be long industrial commodities, like things like silver, which is part precious, part industrial, but things like copper, aluminum, iron ore, and the like. because there's going to be some sort of stimulus, and it will include infrastructure. It just depends on what kind of infrastructure and how big.
Okay, is this bill Dutch treat in terms of how much will rates have to pony up and ante up? Because for the most part right now, they seem to be pretty content at these levels, and no real reflection as far as any indication that they're expecting any movement one way or the other in the near future from the Fed.
Well, I think my dog heard Dutch treat. That's why she keeps coming into the picture. But from a perspective of what's happening with the interest rates, take a look at Germany. We're negative in Germany all the way out to 30 years. It's the same thing in Switzerland. You've got negative 22 basis point interest rates in Germany at the 30-year duration. I mean, that's insane to me. You're talking about almost 0.25% negative. So you're going to probably look for U.S. yields to head in the same direction. Now, negative U.S. yields means gold rallies a lot. I have to stress that.
I like that.
Full disclosure, we're long gold.
Okay.
We are long gold. If you get negative U.S. interest rates, you're talking about a de facto gold standard again. That's what you're talking about, because what are people who are holding gold reserves going to do? They're just going to continue to pay to hold that dollar. I'm sorry, dollar reserves. I said gold reserves. People who are holding dollar reserves as the reserve currency, they just have to pay to hold them. So it becomes a very tricky situation economically if we get there. So I think you're looking at lower U.S. rates over the medium term. I think that's a done deal. But I think you have to look toward the U.S. fighting off negative interest rates here. That, to me, is the scenario. But again, the bigger the package, the more likely we get rates going in that direction.
All right, Bob, definitely something to give us keep an eye on here. We're looking at the inverse correlation between the TNX and gold. Interestingly enough, we've been talking a lot about, you were just mentioning potential for negative rates. We were talking a lot about the Bank of England potentially hinting towards and signaling maybe that's what's next to come there, and even the RBA as well kind of pointed in that direction as well. It'll be interesting to watch the next round of talks there. Bob, into next week, what do you have your eye on, and what should we be keeping an eye on in terms of potential market movers, and what's on the minds of investors and traders as we head into the end of October?
Well, I'd love to point to data, but it's going to be continued progress on vaccines, continued numbers of COVID cases, and if there's any hope of a stimulus before the election, which I don't think there is. I think there's some discounting of the presidential polls simply because of what happened in 2016. Seems to me like the lead is rather large, and you're going to want to watch that because the polls they can make a huge mistake, but they can't make a gigantic mistake. At some point, if the double-digit lead continues in some of the swing states, it's likely that Vice President Biden wins those states. If it gets tighter, now you fall within what I deem to be a larger margin of error than the polls will actually dictate. So I'm not really looking at the election as much as I am on vaccine progress, number of COVID cases, and if there's any hope of a stimulus at all.